Good morning, everybody. It is Monday. It's Monday, August the 24th, and these are the things on our agenda this morning. Briefings from Bessent and Warsh. They bookend the trading week, and bond investors are certainly going to be watching. Canada braces for a long trade war with the United States, but will it play the energy card? And Alibaba raises money in Hong Kong, keeping our focus on the AI build-out.
And the tech story is pressuring, arguably, the European futures picture this morning, and are currently called lower by around 0.2%. It's one of the negative catalysts after a Friday that snapped 7 days of losses. You actually saw a modest gain for European stocks on Friday. Today, though, pointing lower by about 0.1%. To your point, Bessent up front later today, and then Warsh on Friday. The bond market's in focus. Currently yields down about 3 basis points on the 10-year at 4.70. And Brent, oil prices lower today, down 1.4% at $93 a barrel currently on Brent. The countdown to the trade starts right now.
Good morning. How are you doing? Summer's over. Let's get going. It is a big week for markets. We start today with the Bessent press conference. In theory, this should be about Iran. It's going to be about Iran and the bond market. That's going to be the narrative you're going to see. We think 2 p.m. Eastern, the timing's a little bit ambiguous at this point in time. Nvidia's on Wednesday. Looking forward to seeing exactly what it does to these markets. And then, of course, it is Jackson Hole and Warsh on Friday. A massive week coming up. Let's start off with this press conference that we're going to be getting a little bit later on today. In theory, this is about Iran and about the economic D-Day that Bessent is promising. He talked about it in the FT this morning. There are multiple risks around this. How does China respond? That's going to be interesting. How does Iran respond? Could it hit targets in the GCC and further degrade maybe some of the energy infrastructure there? But it's also going to be about the bond market. Bessent tried and failed last week to control the bond market. Trump talked about a military response to the bond market story on Friday. I'm not quite sure where we're going with that one, but it'll be interesting to hear how Bessent deals with it on Monday.
Yeah, and certainly given the drama in bond markets last week, there is a lot of expectation or a lot of focus, and perhaps thin markets also, and therefore the stage is set for what could cause some volatility from Bessent, as you say, talking about Iran, but no doubt being asked about the fiscal story, and he's set himself up to deliver more on the fiscal side. He said as much, but then working towards the end of the week towards Warsh as well. And will we be disappointed on both fronts? Will bond markets be disappointed on both fronts? Will they not get answers to a lower fiscal burden and an attack on inflation?
Because that's what they're looking for from Warsh, but their expectations are pretty low as to whether or not he delivers on that, given his commitment to not communicating in terms of steering that view on the Fed. Obviously, in the last press conference, the bond market sold off significantly. Now, the underpinnings have changed. Arguably, this is a more dramatic setup to Jackson Hole than maybe we would have expected. There is that division now, it seems, between the Treasury Secretary, who's intervening in the markets, essentially, and the head of the Fed, who's saying, let the markets play out, let the markets do their thing. Where do we get in that communication when it comes to Friday? How does he steer around that? And how do the bond markets react?
Well, what do we get today, I think, is the question, because that will then determine. Warsh has got a few days. If Bessent comes out today and says a whole load of things, Warsh has at least got a few days to think about how he's going to be responding to that. How are they going to deal with this? Because every story I read over the weekend, fundamental story is that the US fiscal trajectory is not what it should be. We're either going to have to raise taxes or we're going to have to cut spending. Neither of those two things seem likely going into the midterms. So what does Bessent do? How does he control the bond market?
And the only clue he's given so far about that fiscal tightening is taking action on introducing some sort of fraud task force, which doesn't sound like it'd be big enough to impress the bond markets right now. So there's got to be more to it.
But this press conference is basically about you've got two opponents, the bond market and Iran. The danger is that Bessent underestimates both of those today. And I think, therefore, this is quite a high jeopardy press conference that he's about to deliver.
In the meantime, there are other fights to be had, and there is a fight between the US and Canada taking place now. A trade war is what we see here. And Canada is bracing for what it calls a long battle, a long trade war. They're not expecting a restart of talks before the midterms. And this all fell apart on Friday, and we've seen the US imposing tariffs, Canada Canada retaliating. And why has this fallen apart? Well, the Canadian ambassador to the US has given an interview to Bloomberg where he talked about the written text that they were offered was very different to what had been verbally agreed. And they were saying this wasn't just once or twice, this was persistent through the text that they were working through. And so as a result, in the end, they had to step away. This is obviously negative for the Canadian dollar. We've seen that play out a little bit this morning. But we've seen some real fighting language, haven't we, from Mark Carney? And Lizzie was making the point at the end of the last hour. It's Canada and China who seem to be the ones, perhaps looking to the roles that they play in American imports, who seem to be the ones who are fighting toughest against Trump.
The rhetoric, again, Prime Minister Mark Carney taking the mantle in terms of the rhetoric, the most strident critic of the US in terms of their trade policies, and Prime Minister Mark Carney just underscoring that with that speech on Saturday after those trade talks fell apart. Yeah. September the 8th is when the retaliatory tariffs from Canada come through. It could cost 90,000 jobs, according to some estimates in Canada. And this is what you pointed to in the headlines. Ultimately, do the Canadians look to deploy? They haven't committed this in any way, but it seems like they're opening up the opportunity or the optionality of maybe putting restrictions in terms of their energy supplies to the US, which would be the so-called kind of nuclear card for Canada. Do they follow the playbook of China? China use rare earths. Does Canada use its energy leverage? If it has leverage over the US, is that quote unquote the trump card that they could pull?
Carney's also aware of the fact that the midterms are coming, which I think is interesting. He's playing the politics card as well, and the Republicans up north are starting to get nervous going into the midterms. The other thing he talked about, which really made me chuckle, was he's talking about having your fiscal house in order. He's basically saying, we've got our fiscal house in order, you don't. Wait till the bond market starts to get really troublesome and then maybe come back to us, because there was this narrative as well around kind of how the US is going to get found out on the fiscal front, and it's not as strong as it appears. And he's definitely aware of these kind of two big stories looming, bond market and midterms for the Trump administration.
Should we tie this to what's happening in the tech store? I think we can, because additional tariffs is arguably inflationary. You have the cost. That is one factor that's led to the sell-off in bonds. It's the deficit, clearly. It's the lack of ability for the government of the US to get that fiscal house in order. And then, of course, it's the competition for capital. And we've had a reminder of the fact that this is happening in Asia as well. So Alibaba, with this massive secondary, it's a record, in fact, in terms of the secondary, I believe a record in the Hong Kong markets, raising about 10 billion, the equivalent of about 10 billion US dollars. Alibaba is all in on AI, even as the e-commerce underpinnings of this business start to falter. It's a reminder that there's that competition for capital in Asia as well, as they look to build out in terms of the infrastructure there. SoftBank as well, raising, in terms of a retail bond offering, raising additional capital north of $6 billion US dollars. So those are the two companies looking to raise capital. And on the flip side, returning capital, you're continuing to get disappointment in terms of how investors react to Samsung in terms of that return of capital to shareholders there. And Samsung has been a drag in the Asian markets. Alibaba has not been received well in terms of this capital raise.
Bessent's also hinting that he wants to bring down the cost of capital for tech firms. So that's an interesting side. He's aware of that risk as well in terms of the AI build-out and how important it is. But the big story this week in tech, it's the most important company in the world reporting numbers this week. Nvidia's on Wednesday. That's got to be the kind of... I don't know whether the fiscal story is going to dominate this week or whether it's going to be Nvidia, but it's going to be one of the two.
And we've had a lot written over the weekend, haven't we, about Nvidia putting up prices for some of its customers. And, you know, if even Nvidia is subject to higher memory prices and some of the kit they're talking about goes along with higher memory costs, then that is perhaps remarkable and something we'll return to in the middle of the week.
15%. That's an inflation rate. Pooja Kumra is going to be joining us shortly. She'll be up from TD Securities, Senior European and UK Rate Strategist. Richard Saldanha, Aviva Investors, Head of Global Equities, joining us a little later in the programme. And Daniel Ljunggren, MilDef CEO, joining us a little bit later on. I think this company is the best performing defence stock in Europe this year.
Yes.
So it's small, but it's going to be an interesting conversation.
Yeah, year-to-date gains of about 80%, I think. Yeah. So a really interesting conversation on that front around defence and IT. Let's look ahead to what else we are watching throughout the day and throughout the week. So later today, as we've been discussing, Scott Bessent, of course, the US Treasury Secretary, to hold that press conference on US plans to hit Iran's economy. He's described it as an economic D-Day in a piece for the Financial Times. On Tuesday, Germany's GDP data drops, and we also get the IFO Business Climate Survey as well. On Wednesday, it is that major event that comes through for the equity markets. Nvidia second quarter earnings, and on the macro, US core PCE, so a further gauge on the inflation story in the US. And on Thursday, it is, of course, the Jackson Hole Economic Symposium beginning. On Friday, it is Kevin Warsh delivering that keynote address at Jackson Hole.
Yes, bring on the cowboy hats. We're here for all of that. Coming up then, we will also be talking about what's going on in foreign policy for European leaders. Andy Burnham arrives in Ukraine on his first foreign trip as UK Prime Minister. We'll discuss what's on the agenda. Plus, as the US prepares to isolate Iran's economy, a key question remains, will Washington target China for its support of Tehran? But up next, we will be speaking to Gautham Samarth, multi-asset fund manager at M&G Investments. Just what is at stake this week when it comes to hearing from Bessent and from Warsh. If you want to get involved in any of these conversations, IB plus BBTV Go is the function to use on the Bloomberg terminal. It is Monday. Good morning, everybody. This is Bloomberg. Welcome back, everybody. 7:13 here in London. This is the opening trade. And the European futures picture looks kind of mixed, doesn't it? Flat, really, as we wait for some really big events to develop over the week. We'll be hearing from Scott Bessent today. We'll be hearing from Kevin Warsh on Friday. And in between all of that, we will have no doubt plenty to talk about, including tech. And that takes us where we go next, then.
Yes, Asian equities under pressure in the session so far, dragged down in part by Alibaba. That stock is down a little over 9% right now. The online retail giant turned AI player tumbling then as much as 10% after it raised $10 billion in Hong Kong's biggest secondary share sale. The move underscoring its willingness to amass and spend vast sums to take the lead in global AI. Let's bring in Bloomberg's Anthony Stevens. Anthony, just give us the scale and size of this for Alibaba, what it tells us about their ambitions and why it's been met with such negativity by investors.
This is a pretty big deal in the context of the entire market, right? It's the largest follow-on offering in Hong Kong history. It's a big deal in the context of the market liquidity. It's about a third of the volume of the entire market on an average day. And it's about 3.5 times the normal trading volume of Alibaba if you include the Hong Kong and the US shares together. That being said, the trade went up quite tight because it was priced to the US close, right? So you have to add both the US move and the Hong Kong move to arrive at the total. And in that context, it's tight because the deal came at a 1 sigma move for the stock, which is around 3%, and the deal came at around 3.5%. So what is more interesting is that the deal has broken now. The stock price at the deal was priced at was 112.70. We are below that. So now what do investors do with this trade becomes the much more important and pressing factor for the stock market as a whole. Do they hold on and do they hedge in other names? Do they unwind other names to make risk space for this monster block? Or do they continue to unwind Alibaba in a disorderly fashion in the market? That is what people will be paying attention to, especially going into the Hong Kong close, where the volume will start to pick up. So I'll be watching that very closely. In terms of the HS Tech versus the rest of the market, it will also be interesting to see if the Chinese internet plays can continue to underperform like this as Chinese hardware continues to steady up.
OK, so that's the Alibaba story. And Anthony, that is very much about the AI build-out. And that takes us to the middle of this week. We'll be hearing from Nvidia. They'll be delivering second quarter earnings. What is the market anticipating? What should we be watching for?
The market will be really looking into the details, right? There's a lot of moving parts. They just announced a price hike that looks to reflect some of the supplier pressures that it's been facing, right? Nvidia's suppliers have helped to make Taiwan and Korea the world's best performing markets, but that's come at a cost to Nvidia, which has started to lag its home index very materially. So it's the biggest laggard on the SOX index, one of the biggest laggards on the SOX index, despite being its biggest component. It's lagging the SOX index by 50%. So passing on this supplier pressure will be closely watched in results. Also, Nvidia's CDS has been steadily getting worse as it becomes the AI trade's banker of last resort, right? They're backstopping a lot of debt. They're also investing in a lot of startups. So, there's headlines around them investing into Poolside, and the information is reporting that they may be in talks to invest into Perplexity. So you have Nvidia investing across the capital structure to support the AI trade. How much of that is sustainable when its own business is being challenged by supplier cost? Now, on the other side, it's own customers are becoming some of its biggest competitors going forward, right? You have this custom silicon trend coming from the likes of Amazon, Microsoft, and Alphabet. So what they say about that trade will also be interesting in the results. So a lot of moving parts. People will pay attention, close attention to the details. The implied options move is around 4.6%, which is a big move in the stock. And the stock has been down for 6 days straight.
Anthony, nice setup. Thank you very much indeed. Anthony Stevens joining us out of Hong Kong. So it's a massive macro week. I'm basically assuming that Nvidia is a macro event now. I think it probably is. You've got the presser from Bessent today. You've got Nvidia Wednesday. You've obviously got Warsh coming up on Friday. There's a lot of other pieces that are moving around all of these main events. But it's a pretty busy week on the macro front. Gautham Samarth, multi-asset fund manager at M&G Investments, joining us around the table to kick things off. Good morning.
Good morning.
Which one do you focus on? Where do you focus this week?
It does feel, and I know it's been a busy summer, but it does feel a bit like back to school. All of them, really. I think you'll get snippets of information feeding into some of the key narratives that have driven markets this year. So the bond markets, a real concern, I think, for everyone involved. The Treasury is obviously concerned, is trying to get involved over there. Equities will, at some point, have a bond market sort of competing asset pressure. Yes, term premium increases over time, but asset prices don't sit in isolation, and so.
When does that happen? When does that start? Because at the moment it feels like they're two different worlds.
We've seen parts of it last week, whereby I do think that the long end selling off in the US pressured the long end in other parts of the world, and ultimately then the equity market. You can't have bond yields rise forever and not have it affect the cost of equity. So there is a limited game over there. So we'll find out more as to how the Treasury is thinking about it.
Is it this week, next week? Is that about to happen? Do you get a sense?
I wish I knew. I wish I knew the timing of that. It feels like we're close. It feels like we're getting to sort of a point at which there needs to be some resolution on the call it the equity risk premium puzzle, so the cost of debt versus cost of equity. And then, of course, we've got Jackson Hole. That's been historically the stage to set sort of policy and intention for the next few years. I think Kevin Warsh, given how the first couple of interviews have gone, it's going to be very important. No communication is a form of communication. He's going to have to strike that balance between saying, this is how we see the role of the Fed going forward.
And what's the risk in bond markets, Gautham? Good morning. This week, I mean, what should we be braced for in terms of volatility and some sort of weird summer markets as well? We add in that dynamic. And Scott Bessent has already attempted to intervene, or at least in his words, to focus the market on what he sees as the fundamentals in bond markets. But that didn't deliver long-standing results. It just, it had a short-term impact, perhaps. Is there a risk that, again, the Treasury attempts to direct the traffic and it doesn't manage to? And then how high do yields go?
Well, so we've already seen term premium increase pretty significantly. If you look at, it's about 150 basis points from the Fed funds rate now to where the US 30-year is trading. That term premium is something that you should be able to earn as an investor over time, unless, it increases. That's a sort of your borrowing or you're getting returns in the future, but taking some short-term pain. So the reality is it'll stop selling off, or it'll start rallying when it stops selling off. Today, it's quite uninteresting to own a bond yielding 5.3% when you can get that 5.3% in an equity market elsewhere in a couple of weeks' time. So it does have a competing problem, but the point early on is there's a circularity to this. At the point at which the bonds affect equity pricing is the point at which the bonds actually start to get interesting.
Okay, so that's in terms of the bond market strategy and how it rubs up against equities. But you talk about a disinflationary boom. Are we worrying too much about inflation? Are bond markets worrying too much about inflation?
I think bond markets are worrying about the price of bonds today. It feels a bit more circular than that. I think it's the reaction function of risk is recent price and volatility rather than an expectation about inflation. Inflation has been surprising to the downside more recently. and growth has been surprising to the upside recently. Though that's a pretty good combination for asset prices in general, but if you're really worried about inflation, the heat should be coming off. That's not happening right now.
Well, Nvidia is putting up prices, according to reporting, for some of its offerings, 15%, around 15%, to try and preserve that margin as 75%. What are you be watching for from Nvidia and their ends? What do they need to deliver, do you think?
I mean, I was just looking at the projected growth numbers. They're pretty staggering, growing, 97% in the headline for 2Q. They've got a high bar, but ultimately we have to also acknowledge what's happened this year on the earnings side, which is off of a very high base on aggregate, and I'm not just talking about Nvidia right now. We're probably going to get 15 to 20% higher earnings delivery this year than we expected at the beginning of the year. That translates to much bigger numbers when you look at parts of the semiconductor chain. So the AI build-out is real. There are bottlenecks over there which are resulting in price hikes, as you pointed out, and you have to be conscious of that. So I wouldn't get in the way of some of those things, but you also have to be conscious that when bottlenecks arise, the world or the global economy has been pretty good in solving some of these bottlenecks. So the last 3 shocks have been inflationary in nature, but we've got around them. If you talk about the energy shock, if you talk about what happened in the Ukraine invasion starting up over there, we've gotten around those problems, those supply chain problems, and I think the world economy is pretty robust to deal with the bottlenecks in tech as well today.
Okay, Gautham, thank you very much indeed for coming in bright and early this Monday morning. Kick things off for us. Gautham Samarth on a busy week, as we've been discussing, multi-asset fund manager at MNG Investments, on what to watch for through this week.
OK, Monday morning. What else we need to know this Monday morning? Let's get you up to speed. Shein is seeking to raise up to $1.8 billion in a Hong Kong IPO. The fast fashion retailer targeting a market capitalisation of up to $27 billion in its debut, which we think is going to be in and around September the 1st. The move comes amid continued regulatory pressure in the United States, where Bloomberg understands that authorities are conducting a national security review of the company's purchase of the American clothing retailer Everlane. Italy's government has announced it is extending a tax cut on diesel fuel duty until Wednesday. This as Prime Minister Giorgia Meloni tries to manage the impact of the Iran war ahead of what is expected to be a general election next year. And the European Commission has approved over €6 billion in new defence procurement funding for Ukraine, covering air and missile defence systems, ammunition and radars. The funding is part of a €90 billion Ukraine support loan. The announcement comes just as Andy Burnham has arrived in Ukraine on his first international trip as the British Prime Minister. Burnham will meet President Volodymyr Zelensky and co-chair a meeting alongside the German Chancellor Friedrich Merz and the French President Emmanuel Macron, who will join via video link. It's interesting, this is where he's going first.
It is a sort of statement of the foreign policy priority, I guess, and he's been very domestically focused. But this does take him onto the international stage. It forces him to talk about things that are not to do with the cost of living, which is where he's been more comfortable. And this is alongside other European leaders, 35 years at the anniversary of Ukraine's independence, and people are using that as a date to once again refocus the international attention, or to attempt to, back on Ukraine.
At a time when Zelensky's made it very clear that Ukraine desperately needs those Patriot missiles to be able to ensure that it has the defences, and Russia has been taking advantage of that. We've been talking about the fact that Andy Burnham is very much focused on the domestic side, cost of living. Well, there is the cost of living impact in terms of what's happening with corn prices. You've seen corn prices shoot up, what's happening in the Black Sea.
Wheat prices, all these things.
Wheat and corn prices, Ukraine and Russia, and what's happening in the Black Sea. And that is leading to further inflationary pressure, arguably as a result of these lower yields and higher crop prices.
Yeah, another inflationary input. It's interesting. People do see a disinflationary world at the moment, but if you, in aggregate, just sit here day by day by day, it just feels like there's more and more supply-side shocks that the world has to contend with. OK, coming up as markets await more on Scott Bessent's fiscal plans. In that context, we discuss the latest bond market moves with TD Securities' Pooja Kumra. That conversation and analysis is coming up next. This is Bloomberg. Monday morning. How you doing? 30 minutes to go until we start equity trading. Bond markets are beginning to open up. That's getting quite interesting as well. We're going to focus on that in a second. Quiet start to a busy week, I think. I think it gets busy later on today. That's going to be the story with the Bessent press conference. But this morning, you've got most of the European markets just hugging the flat line, as they have been over the last few days. But at least we broke the down line that we had in the Stock 600 Friday. That was at least a little bit of positive news coming through.
Let's have a look at the bond markets. And there we've got yields coming down a little bit, if that's positive in the context of what we saw last week. Let's have a look at where we are on European markets, opening up right now and not a huge amount of movement. A lot of things to focus on, whether that's competition from raising money by tech companies, of course, the inflation fight. We'll watch Kevin Warsh at the end of the week, of course, and the fiscal situation in the US, and we'll hear from Scott Bessent early on this week. So there's lots of things that for global watchers of bond markets could be in focus. In that context, the French government talking about working on renewing fuel aid, which could feature in our next conversation.
Yeah, we've seen similar steps, haven't we, from the Italian government, at least considerations around trying to alleviate some of the pressure at the pump over in Italy. Let's bring a deeper dive on these global bond markets. Bring in Pooja Kumra right now, European and UK rates senior strategist at the TD Securities. Pooja, good morning. Anna's been framing this as kind of a weekend that's bookended by Bessent at one end today and then Warsh on Friday. So let's start with Scott Bessent. Is there anything he can say on the fiscal situation that would do anything to pull yields lower and see a bid for treasuries? What would he need to outline to convince investors that this is a government that's serious about addressing the deficit?
Yeah, yes, everyone has more questions than answers right now. I think we really want to address what is this toolkit. Because we had the Fed FOMC meeting where we were told by Warsh that we want the markets to do the work. And then last week we had Bessent coming that, no, we don't want markets to do the work. So I think we want to know where is that clarity. We need to know that whether they are ready to actually reduce the long-end issuance. I mean, they have already given us some kind of feelers when it comes to the refunding report, but also how much they can buy. But I think if you think in total, this is no longer, it's not a long-end supply issue, right? Long-end in US is pretty much like 10% of total supply. It's more about there's so much unpredictability as to how they are going to get the fiscal deficits lower. Also, when it comes to monetary policy, what they are going to do with respect to the inflation premium that is actually growing in the long end of the curve. So I think it's a mix of two, not just a Bessent play for long end.
Is there a higher chance that we resolve one of those two with Warsh maybe addressing how this Fed looks to deal with inflation? Does that seem more likely than a Treasury Secretary who outlines a convincing plan to address the deficit?
The thing is, at this stage, it's hard for them to actually give us a big plan to actually buy back the entire bond market, right? What is it justified against, right? The financial conditions are still fine. We are not in 2022 or 2023, where the Fed had to intervene or when the BOE had to intervene when it was hitting the financial conditions. So I don't think Bessent can present a big plan to actually appease the long end of the curve. And that's what we saw last week as well, right? Just some buybacks, 2 to 4 billion in a quarterly supply, which is so big, does not really change the momentum for the long end. So I think for me, it's still a monetary policy predictability that needs to be clarified at Jackson Hole. The entire bear steepening move actually started at the July FOMC meeting. So that is where I'm looking at.
Is Europe going to pay the price of higher US rates?
We are already, I mean, we have such strong correlations that we will follow the same move. But one thing we know that if markets are not clear about the predictability factor in US, you would see US underperform Europe. We saw it in the currency, and we will see the spreads also widening.
Yeah, is it the dollar that ultimately really takes the... How bad could that get? Like, how far through that process are we? How much more unwinding could we see of the dollar trade?
So the thing is, like, everyone is comparing this to the Liberation Day scenario. I don't think it's that bad. First of all, we do have the August illiquidity that's adding to everything.
Sure.
And also the fact that, that time there was a big hedging flow also going through, right, which we were not aware of also. Markets did not know what is happening. So I don't think that the move is going to be that big. We will need a consistent backup in US yields and markets actually severely reacting to the September FOMC, which I think is less likely the case, given the fact that I think Warsh has got some feelers about the price action. So in short, after the entire story.
Yep.
I don't think the similar price action. I'm a strategist. I love talking.
Yeah, we enjoyed the story, Pooja, so that's good. You seem more focused then on Warsh than Bessent this week in terms of what's going to move the markets that you're focused on. Are we just not going to be disappointed again by an intended lack of detail from the Fed chair?
Certainly Bessent, if he talks today, he can get small support to the long end, but like last week, I think it will not be very sustainable. But again, it all comes to Warsh because no one understands the reaction function. And I know we are being a bit too harsh on him as well as in markets in terms of testing everything that he says, but we do need some clarity as to the fact that, Fed is taking the decision and not the markets for him, right? I think inflation needs to be controlled by the central bank.
So that was what caused all of the drama after the most recent FOMC meeting, was the lack of forward guidance. But then if we've seen this sort of disinflationary impulse coming through more recently in the US, does that mean the markets get off his back a little bit and we cut him a bit more slack?
I think that is going to be the case just because, we just need a united Fed. I think if we see that and if we see a plan, markets will be convinced and we can give some space to the Fed as a whole because clearly they don't need to hike in September. So far, the inflation data has been in the right direction. Labour market has been in the right direction. We'll have one more report for them to get better color. But there's no urgency that we saw back in July that they have to act right now. And that's why markets also not pricing much for September.
Pooja, should global markets brace for an inflation shock, potentially?
Well, with oil not going down, there is a risk.
But it's not just oil, right?
Yeah. Natural gas. The one thing that we are, at least in Europe and UK, we are seeing that wages are still very well contained. And that's what is also visible in US, right? Even non-farm payroll has been up and down, but the average weekly payroll has been still in the right direction. And I think that's where you can believe that the fact that you will not have a permanent inflation shock. But I think markets don't really trust the process of disinflation anymore, just because we are still not at the 2% target anywhere.
France, Europe, Italy. Fuel prices are going up. The French and the Italians are both talking about trying to help consumers out. Do we have the fiscal space? We're going into the French budget debate now. We've got an election coming up. Do we have the fiscal space in Europe to be able to deal with this inflationary shock going into the winter that diesel provides, that gas provides?
I think France definitely does not. We really cannot move from that 5% level. I think Italy still has some space.
Yeah.
But markets are just not forgiving for any fiscal, right? And especially given the fact that it's just not fiscal, it's also the fact that all these countries go for elections next year as well.
Yes.
One thing that's changed for Europe this time is that we are not seeing any issuance at the EU level, right? So all these countries have to fund for themselves. And I think if France goes ahead with more support without any cuts, markets will actually punish it. We did see O80s versus Bund spreads hitting closer to 85 basis points last week. Again, this has been more of an oil and the global bearish move, but if we add to this, if there's another fiscal move, it can be pretty brutal for the French spreads.
Yeah, but is that spread, O80 Bund spread, is that capped, Pooja? And if so, by what, do you think?
So for me, it's still around 90. I mean, those are the levels we have seen last 2 years as well. One thing that is clear about the French story is that we know about it. Markets have known about it since 2024. And also the fact that most of the debt in France is held by the domestic. So I think that reduces the de-risking that we saw that led to the entire sell-off, right? So I feel that there is a cap, but we go through this every August. Like, we are used to the French spreads blowing up in... So both French as well as in UK, I would expect that markets will be scrutinizing the budget side.
Oh, yeah. Pooja, nice to see you. Thank you very much indeed for coming to see us. Pooja Kumra, European and UK rates strategist, senior strategist at TD Securities. OK, let's get back and talk about what is happening with US bonds. Some Fed policymakers are playing down concerns over rising US Treasury yields.
There's every indication that the U.S. Treasury market is functioning as it should, that trades are taking place, that there's liquidity in the market. And so that enables us to focus on the federal funds rate as our primary policy tool to get inflation back down.
Neil Kashkari, of course, the Minneapolis Fed president, speaking there, a voting member, of course, on the FOMC, speaking to CBS's Face the Nation ahead of Kevin Warsh's big speech Friday at Jackson Hole. We're going to talk about the bond market. We're going to talk about central banking. We'll do that next. This is Bloomberg.
Welcome back. 16 minutes away from the opening trade this Monday. Global stocks currently in negative territory. Risk off. You're seeing selling pressure over in Asia. European futures pointing lower by 0.2%. US futures on the Nasdaq 100 called lower by 0.8%. Just the FTSE 100 looking to gain just a modest 12 points.
OK, let's talk about what's happening with the price of crude. Down a little bit after 2 weeks of gains. This is the market waits to see exactly what the US economic isolation plan for Iran looks like. Treasury Secretary Scott Bessent is set to unveil details, we think, at a press conference later today, timing a little TBC. So let's bring in Bloomberg's Abir Abu Omar in Dubai for what we should be looking for. So what's on the agenda here?
Good morning, Guy. Well, TBC is what you just have mentioned. We have to await, of course, the details of what Scott Bessent will lay out in this press conference. But what is widely expected is an announcement of some kind of secondary sanctions against countries that continue or choose to continue to do deals or trade deals with Iran. Now, that, of course, includes countries in the Gulf, namely the United Arab Emirates. That, of course, includes India and the big one, China, which buys about 90% of Iranian oil. China actually came out over the weekend and said that it will continue to support the diplomatic route between the United States and Iran. But any kind of secondary measure against China will bring out a bigger conversation about tariff or trade wars between the United States and other countries. But one thing is for sure, all we have to wait for is that announcement from Scott Bessent. And what exactly will be the details? He, of course, wrote for the Financial Times earlier saying some powerful words, Guy, along the lines of to become a sanctuary for terror is to become, in the eyes of the United States, a global pariah, signaling that whatever he's going to come up with in terms of this economic isolation plan is going to carry wide implications for countries that choose to continue to do trade with Iran.
Yes, and the US president is well, hopes, I suppose, that the measures that he will bring in, that Bessent will talk about, will force Tehran to accept a deal, Abir. What is the likely response, we think, from Tehran? I suppose it depends what level of escalation is still possible in terms of sanction.
100%. I mean, that's the reality of the situation. The IRGC did come out, Anna, and did say that they have scenarios laid out for any kind of economic isolation plan that the U.S. has in place. Now, it's not really clear how Iran will choose to retaliate against what the U.S. lays out, but there are a couple of puzzle pieces that are in order. One, the U.S. naval blockade continues to take place. The Central Bank of Iran did say that its oil exports, are now virtually at zero. But what a lot of analysts are telling us is this may spur some kind of reaction from Iran to come back to the table. But if there are meaningful economic actions that are going to be taking place laid out in the press conference later today, it'll probably take months, about 6 months, for Iran to feel any kind of real economic pressure to succumb and come back to the table. Because for the time being, while the exports are at near zero, Iran still asserts dominance over the Strait of Hormuz, or it claims that it still asserts dominance over the Strait of Hormuz. Of course, we've reported multiple times that the number of vessels that are able to make their way through the waterway is virtually very, very close to zero. We're reporting that, of course, there are about 3 to 4 million barrels of oil that have been able to go through with these ships and vessels going dark in the Strait of Hormuz. But that's, of course, nowhere near the levels we were at pre-war. And that is, of course, because of the double blockade of the U.S. and also the dominance that Iran continues to assert over the waterway. That is also to not neglect the action that is happening in the Red Sea with the Yemen-based Houthis forcing Saudi Arabia to take different routes through Africa, as a matter of fact, to be able to stay away from the danger that they have over this very important other choke point that is now under attack. So all of this is to just say that, yes, economic pressure could force Iran ultimately to come back. It could also force it to retaliate once again against countries in the Gulf. And then you're looking at a situation similar to the end of February, early March, where the parameters of this war are escalating yet again.
Abir, thanks very much. Bloomberg's Abir Abu Omar in Dubai. Let's turn now to today's markets in 3 minutes on the opening trade with Markets Live Executive Editor Mark Carney. Mark, let's think about what we might hear from Scott Bessent, I suppose, at the start of this week. That seems to be a big area of focus. Yes, he's committed to talk about Iran and what could happen there. That could bring China into the mix, could be a macro event. Or could we be focused on the fiscal story out of the US? Because he's also suggested he'll be talking more about that this week. What do we expect from Bessent and what volatility should we brace for?
I think that the fiscal side of what he says will be under more scrutiny. I think everything that Scott Bessent says at the moment will be under scrutiny, given his actions and the statements he's made in the last couple of weeks. Some of the statements in particular have not seemed to kind of chime very nicely with kind of a fact-based reality sometimes, and maybe have kind of raised extra scrutiny of all that he's doing. So I think the actions on the fiscal side will be important, given his intervention into the bond market last week, given people are worried about the fiscal path, given that Scott Bessent said last week that the deficit may already have peaked, and implying that people had bad information if they thought yield should be higher and that yield should be lower. So a lot of scrutiny will be around that. But of course, that is not entirely separate from the whole economic D-Day in Iran and the plans around that and what that will mean in terms of trade, because obviously there might be secondary impacts if people retaliate in trade measures, and of course what it means for energy prices.
Two of the US's most powerful, the two most powerful men in charge of the economy up on stage this week then, Mark. So we're thinking about Bessent, but also thinking about Warsh. What do you think Warsh has to deliver for the markets, for the bond markets, to keep yields capped?
I don't expect Warsh to deliver much of relevance. This is a guy who's one of the key pillars of his mandate, of his plan as Fed chair, is to stop providing so much commentary and guidance to the market. The headline of the talk is not related. So, yes, Fed chairs have gone off script to kind of make policy measures, but that would be completely antithetical to what Kevin Warsh said he plans to do. So it'd be very strange if he mentions yields. That'll have a big impact, but it'll also show a little bit of panic and kind of going, oh my God, even Warsh is giving up the idea of not controlling the kind of market. Like, supposedly the narrative right now is Warsh is saying, let the market do what it wants. And Bessent's going, no, we've got to control the market. And now if Warsh goes, oh, actually, sorry, we do have to control the market, that would be a big impact in markets, but I'm not expecting it.
Mark, it's still August. In theory, the summer is still on. In theory, we've got light volume this week. What's the potential for an accident this week, given that light volume, and the potential for, therefore, greater volatility?
I think we're going to have a lot more volatility this week because we've got quite a few brewing themes that all have potential tipping points. There's the US-Canada trade war, there's the Iran situation, there's a lot going on in the AI space, and of course then there's treasury yields that may break out. I don't think we're going to have sudden panic. I mean, the underlying macro backdrop is quite supportive, but this week should probably be more volatile. And volatility is not great for risk appetite. So I expect that to be volatility with a slight negative tone.
OK, volatility with a slight negative tone. Bloomberg Markets Live Executive Editor Mark Carney. Mark, thank you. Remember, you can get up-to-date analysis and insight, of course, from Mark and the rest of the team. Just go to MLIV Go on your terminal. Let's get your stocks to watch this Monday. Bloomberg's Louise Moon standing by. Louise.
Good morning. Starting off this morning, looking at European miners. Now, obviously, both gold and copper outperformed last week. Strong weeks there. Now, we're seeing gold hold on to those gains this morning, but copper easing slightly. So we're going to see how that impacts European miners. You can see year to date, they have all soared up around 20-30% across the board for them. So we'll be keeping an eye on them this morning on the back of those prices. Now, sticking with commodities, but moving over to a bit of M&A, we're looking at Shell. Now, there's been a report that several bidders have put in non-binding offers for Shell's US chemicals units. So that's been a report early this morning, saying that it could fetch as much as $8 billion US dollars. Now, seems like a steep price, but actually it's quite a discount to how much Shell has reportedly put in to those assets. Now, you can see since 2023, when their CEO joined, bit of a rocky start, but has been performing better recently, overall about over 40% gains. He's trying to go back to their core of oil and gas and divest those underperforming units. We'll be keeping a close eye to see if that deal comes through. And then finally, looking at Big Yellow, they've had a rating change. Barclays has pulled down their rating, and actually the new price target implies about a 9% discount to their last closing price. So if you look at their ratings now, we've got 4 sells, 3 holds and 9 buys. You've seen over the last few months a few analysts have been downgrading. If you take a look at their share price, early this year talks with Blackstone over a takeover collapse, and since then it's kind of been struggling to recoup those gains, and a few of those rating changes have happened in that time. So a new ratings change there from Barclays.
Louise, thanks very much. Bloomberg's Louise Moon. I'm glad Louise mentioned miners, because iron ore prices, as she said, I think up by 1.9% this morning. We'll watch that. Anything linked to precious metals as well could be in focus. It's not really a micro day, is it? There's a lot of macro themes this week.
It's going to be a big macro week. I did just note that the Nasdaq is down by 7/8% this morning, and under a little bit of pressure, and heading south. So the tech trade is also going to be a narrative maybe into the European Open too.
It's Nvidia week. European stocks called lower by 0.2%. Bloomberg and the opening trade. Coming up, this is Bloomberg.
OK, here we go. A couple of minutes to go until we start trading this Monday morning here in Europe. US futures are rolling over fairly sharply at the moment, particularly Nasdaq futures, which is interesting. This was the legacy coming out of the Friday S&P session. We closed there in Europe. The American market, the S&P, finished pretty much in line with that. So I don't think there's actually much of a tell coming out of this chart, but there is probably coming out of US futures, which are negative, and it looks like they are tech negative, Tom.
European futures are also pointing low by 0.2% after snapping 7 straight days of losses on Friday, with some gains today pointing low by 0.2. In terms of the mining sector, that could be a bit of a support for the FTSE 100. You're seeing higher prices for iron ore, for gold and for silver. FTSE 100 futures, though, pointing out just by 5 points, so not much support, but there's a little bit there. DAX futures, though, called low by 45 points, currently pointing down by 0.2%, Anna.
Yes, let's in fact pick up on one of the themes you mentioned there then, Tom, and think about which sectors and stocks could be on the move this morning. And we'll start with the mining sector. As you mentioned, iron ore prices are stronger this morning. We've certainly seen that as a feature of these markets, fading a little bit perhaps as we go through the session, but certainly they have been higher and continue to be up by 1.6%. We also see, as you mentioned, gold and silver higher, in particular gold, and that's been really in focus last week with the travails of the dollar around the fiscal story in the US. So gold is up by another percent. So we watch everything to do with the miners. Shell is certainly in focus. BP is the FT is reporting that Shell is attracting interest from several potential buyers for its US chemicals business. They're seeking to do divestments, of course, as we know. And GSK has had approval on a number of different fronts. The first global approval for a drug called Hibsago, that's in Japan, and also they're getting FDA approval for a rectal cancer drug in the United States called Jemperli. So we'll watch the drug space, Guy.
Keep an eye on both of those two sectors. OK, let's get these markets open. Let's get Monday morning underway. Let's figure out what we should be looking at. I'm expecting a fairly quiet picture, but with US futures rolling over, I think it could get a little bit more exciting later. Plus, we've got the Bessent press conference coming up. It's a busy macro week. That's the narrative. Europe sitting on its hands maybe before these major events really come into full force, and I suspect that's going to be the trade this morning. But as we get into the afternoon, things are going to hot up and get a little bit more exciting. Maybe we've got to digest the Bessent news tomorrow morning. But the FTSE is fairly flat. Stock 600 is flat. The German market is already open, which tells you nothing is happening there. But keep an eye on Volkswagen as well. There's some interesting meetings coming up there this week as maybe Labour pushes back against job cuts. AEX is down by 0.2%. Is that the tech trade? IBEX is flat. FTSE's flat. CAC's doing nothing. That's about it so far. I would say maybe there's a little bit of tech weakness in the market, judging by the AEX. Let's see how Shell and those miners trade as well when it comes to the materials sector. Tom?
Yeah, the tech weakness is there, Guy. That sector is coming through the biggest losses right now on a sector basis. So tech is down 1% right now. Energy on slightly weaker oil prices, at least in the session today, is also down 0.5%. Autos off by 0.3. On the upside, the biggest gains right now coming through for personal care, currently up 0.5%. Travel and leisure, interestingly, up 0.5, maybe again on that slightly softer oil price, at least in the session today. So, top of the list right now, personal care on a sector basis. Bottom of the list is tech, down 1%, with Nasdaq futures, as Guy was saying, currently called lower by 0.8%.
Yeah, it's interesting on the energy story that, yes, we see weakness in those energy names, obvious because of the weaker oil price, down by 1.8% on Brent, but Shell is actually pretty flat, and maybe that is the asset sales story, the FT reporting some numbers around that, so we'll watch that one and see if that one develops into anything. But, yeah, we're sort of 50-50, sectors going higher and lower this morning, which is not the same as the US futures picture.
Well, actually, I would say in some ways is quite a defensive bias in the market this morning. Nestle is your biggest points gain. So you're buying Nestle to hide out from the tech trade, which is definitely hitting ASML. Biggest points drag by some significant margin. ASML is down by 1.3. That translates into kind of it is, in terms of points, it's the next 3-4 stocks in terms of the points drop that it is providing, all aggregated into one. But it's ASML is down, Siemens Energy is down, Process is down, SAP is down, ABB is down. So it's their kind of tech plus adjacent tech trade.
Which, as you suggest, is similar to the US trade then, isn't it? Where the Nasdaq is underperforming. So that's Nasdaq futures down by 0.8%. Let's think about where we are now on global stocks. Richard Saldanha joins us, head of global equities at Aviva Investors. Richard, very nice to have you on the programme this Monday. As we spent a lot of the team has spent a lot of the last week or so talking about higher yields, and we see some respite from that right now. In today's session, we're away from those multi-decade highs at the long end of the US curve, but that's still a narrative we're watching with all of these macro risks this week. How vulnerable are global stocks to higher yields, do you think, right now?
Yeah, it's certainly a big question at the moment. And it's fair to say, when you look at how equities have performed this year, right, up double digits versus what's been going on in the bond markets, it's fair to say equity markets have been sort of relatively immune in many ways to kind of what's been happening in bond land. I think what's interesting for us is obviously as you continue to see these yields push higher, intervention now starting to come into play right at the longer end of the curve, and exactly what that kind of means going forward. Obviously, inflation, expectations also continuing to somewhat trend higher, obviously, given the ongoing conflict that we're seeing at the moment. So, look, I think big question mark for us is at what point do you suddenly get to a pain point? And I think if you look at that 10-year, as we start to push closer to that 5% mark, you could argue that's where it starts to get into sort of more pain territory from an equity perspective. But I think you've also got to remember that a lot of the reasons why equities have been resilient this year has been the earnings backdrop. Right, you look at the earnings season in the US, even in Europe, across the globe, you've got earnings that are pushing 20% right now. So, year-over-year growth, right? So in that sense, equity markets have been able to digest this, mainly because the earnings backdrop has been so strong. But make no mistake, rates do matter. Yes. And I think as you start to see that 10-year push to 5%, I would suggest that starts to become more of a pressure point.
OK, and so if we were to get towards that pressure point, would that be another reason to diversify? Would that pressure hang more closely to some of the names that have done best out of the AI trade?
Yeah, look, I think the diversification point is still very much valid. I think what's interesting as we start to think about, obviously, what's really been underpinning the equity market from an AI standpoint has been that hyperscaler capex expenditure, right, that data center build-out. Now, largely, so far, that's been funded out of operating cash flows. As you start to see this shift now into tapping into debt markets to fund some of this spending, clearly that has implications from a cost of capital standpoint. So in many ways, to your point, as we push closer to that 5% mark, if we do get there, I think it makes even more sense to think about diversification from an overall portfolio standpoint.
What's the play around diversifying within tech, Richard?
Yeah, so look, I think within tech it's interesting, right, because obviously we've had this broadening out so far this year, right, where you think about, the semiconductor complex, it's broadened out into areas such as memory, networking, storage, etc. But we also know that comes with a lot of momentum there, the supply-demand dynamics. I think what's interesting from a tech standpoint is it's almost looking outside the US to us when you start to look into areas such as China, the hyperscaler complex there. There's an AI story playing out there that actually is very idiosyncratic from what's playing out from a Western perspective there. So that is one way to think about diversification. And what's quite interesting when we saw the jitters playing out in the semiconductor complex, particularly when we think about June and July, actually what you saw in terms of the Chinese tech complex actually held up a lot better there. So I think there are ways you can even think about diversifying even within the tech complex. But for us, it's also looking to other sectors, whether it be sectors such as healthcare, consumer staples, those natural counterbalances when you think about it to the AI trade.
Does that take you to Europe when you're thinking about healthcare, consumer staples? What role does Europe play in that?
Yeah, I think it's global, to be fair. I mean, Europe is interesting, right, certainly when you think about, particularly you touched on Nestle this morning and obviously offering a little bit of shelter when you see the tech complex sell-off. I think when you think about the staples complex in Europe, you've got companies such as Unilever that are certainly still delivering solid volume growth as their story there. European healthcare is in an interesting space right now, certainly relative to what we see in the US healthcare complex. It's struggled a bit, and obviously we had the blockbuster news last week on Merck and Moderna in the sort of cancer vaccine complex that sort of, really lit the touch paper in many ways on the US healthcare sector. Europe still has a bit of catch-up to play there. Certainly we've seen, the likes of AstraZeneca, Roche, etc., have been a bit weaker versus their US counterparts. But we still think it's an interesting story, particularly when you think about the M&A side of things, these companies starting to deploy more of that balance sheet. We think that's the theme that'll continue to play out this year.
One of the ways you could argue that equities could be seeing the world right now is that higher bond yields signal high nominal growth. And that, in theory, could be good for equities. Is it good for equities to a point?
I think to a point is absolutely the right way to think about this. I think we also need to think about the dynamics, right? So in many ways, and obviously as we sit here right now, a September hike is very much on the table, certainly when you look at the markets as things stand right now. I think from our perspective, look, equity markets can digest hikes as long as they're in an orderly fashion, right? It's when you start to see big shifts within the sort of bond complex that starts to become more problematic from an equity standpoint. So look, from that perspective, we don't see that as a bad thing per se if we're talking about hikes. Obviously in a backdrop right now where growth continues to remain relatively robust, US consumer seems to be holding up pretty well, certainly those sort of key points that we're looking at there. So look, I think from that perspective, equity markets can digest this, but clearly, as I said, when we get pushing that 10-year closer to 5%, that is it will get a bit more problematic from an equity perspective.
A lot of people come on the show and talk about earnings. Earnings are great, and it's indisputable. The earnings season has been phenomenal. But I'm wondering why. And two of the reasons that strike me it's been very strong is, one, corporates have got very low cost of capital at the moment. In some ways, you could argue bond yields are still... Borrowing is still available and still relatively cheap versus history. And tax rates are unbelievably low. And I'm just wondering if some of these things are going to start to change. Some of the tailwinds that have been there, very low rates, starting to change. Governments starting to get quite stressed. How do they fill their bucket up? One of the ways they could do that would be raising taxes. Now, I know that's unlikely into the midterms, but it's possible that the US at some point has to sort its fiscal house out. Do you think is this peak earnings? Is this as good as it gets? Because if it is, then the second derivative factor is going to start kicking in here, and it's going to get harder and harder and harder.
I don't particularly view it as peak earnings, to be honest with you. And the reason I say that is actually, if you look at it, obviously the earnings that we get reported, you're looking at it from a rear-view mirror, right? But in many ways, we look at the forward lens, particularly where companies are guiding to right now. That's also really robust, actually, when you look at the forward guidance from companies. So to me, that suggests that not only are companies delivering earnings right now, they're actually pretty comfortable, into the future in terms of that ability to keep on delivering. And let's not forget, we are lapping, from an earnings standpoint, some pretty high numbers, right, when we think about the last 3 years. So, look, from that perspective, we still think that continues to play out. I think that broadening story is interesting when you think about under the bonnet what's going on right now. Tech has done so much heavy lifting when you think about the last 3 years from an earnings standpoint. And what's interesting to us is it's sectors actually that aren't correlated to AI, right? So you're seeing, banks coming out with solid numbers. Industrials, we think, is quite an interesting space, particularly when you start to see a little bit of that pick up in activity, very much focusing on the PMI side of things. So I think that bodes well if you continue to see that play out as well. You've got the consumer sectors, as I've highlighted, the US consumer actually holding up relatively well. Some signs actually even in that sort of lower to middle income cohort, some spending coming through there. Obviously, we talk a lot about this K-shaped economy.
Do you see the retail sales
number? That's playing out. But, so I do think, there's definitely reasons from a fiscal standpoint to have that concern. But I think actually when you look at the earnings backdrop, still very robust.
And for shareholders then, Richard, what does the return of cash look like right now? As we see a lot of companies under pressure to spend, or to invest in CapEx, to do AI build-out or to invest in that kind of technology. What does the income and buyback story look like from here?
Yeah, the buybacks continue to be pretty robust. I think what's interesting actually is there's a big story playing out almost outside the US when you think about the buyback side of things, right? So Japan's been fascinating, right? When you look about what's been going on over the last few years, huge step up in buybacks there. Companies really starting to deploy that cash that's there. But from a global perspective, you're still seeing balance sheets in pretty healthy shape. Companies continue to deploy that cash. You're obviously seeing some pockets of M&A, as I referred to in the healthcare space. So again, companies thinking about it not just from a buyback perspective, but also thinking about bolstering future growth. So again, I think as a barometer in terms of corporate, confidence and health, that remains solid. The capex continues to trend high across the board when you look at it as well. Again, that intent to sort of spend there continues to be pretty robust there. So I think all those key indicators to us, and obviously it does go back a little bit to where we started, right, in terms of obviously the bond markets continue to kind of, show some volatility, but the actual fundamentals from an equity standpoint still remain pretty healthy.
Nice to see you, Richard. Thanks for coming to see us. Richard Saldanha, Head of Global Equities, joining us from Aviva Investors. Call 6 looks like this. Tech's under a little bit of pressure. Nestle getting maybe the benefit from that, as you can see, up by 0.3%. Defence stocks down a little bit. We'll talk about defence stocks in just a moment. Let's dig into some of the other details that we should be thinking about this morning. Louise is here with that.
Morning, guys. So starting off with BW Offshore, shares down almost 14% there. That's after they've cut their full-year forecast for BW Offshore over in Oslo. Now moving on to miners, taking a look across all of Europe. Let's see how they're performing. Just all into the green, but only just slightly. Now, this is obviously on the back of gold, copper, iron ore price moves. Keeping an eye on those throughout the day, but all into the green there. Now, moving on to the next stock, we just changed the board. Looking at tech, a very different story for tech there. We look at process in particular, all down into the red on the back of Alibaba seeking that share sale, and tech really being a focus globally across markets. And then finally, the last one we're going to take a look at is MTN Group. Now, they've had an update this morning, and it's boosting their share price into the green. They've issued a buyback, almost $400 million, and also reaffirmed their guidance. So a bit of positive news to end on.
OK, Louise Moon, thank you very much indeed on some of the stocks on the move this Monday. Coming up, the US and Canada heading into a new trade war. We discuss how it could play out, the implications. That is next. This is Bloomberg.
Welcome back. This is the opening trade. Welcome back. This is the opening trade. We are 17 minutes into the European session, and the European equity market picture looks a little lacklustre, influenced perhaps by tentative moves or negative moves, I should say, over in the Asia session, down by 1.1% on MSCI Asia Pacific. We're sort of boxed in by that, and the US futures picture, which also looks a little bit negative, down 0.2% on E-minis, and Nasdaq futures leading the way downwards. A lot of nervousness then, Guy, around tech, and some of that is coming through in Europe, even if just slightly more sectors heading north than heading south today here in Europe.
Absolutely. And a massive week coming up for tech in the form of Nvidia, Wednesday. Look forward to that. One of the key dates for this week. So much going on, so much macro news that we need to fold into our thinking this morning. Bloomberg is learning that the Canadian government sees little chance of trade talks with the United States resuming before the midterm elections. That's November. This as the Canadian Prime Minister Mark Carney announced the country will apply $20 billion of counter tariffs on US products. Christina Freeland, the former Deputy Prime Minister, the former Deputy Prime Minister of Canada, spoke to us yesterday about the situation.
We don't see this as a zero-sum game. We don't see this as about dominance and submission. We think we can reach a deal that works for both parties. I think at heart, that is not President Trump's view. And that is a real problem. And it's a problem not only for Canada, it's a problem for the United States.
OK, let's talk about where we go from here. Bloomberg's global trade coverage is led by the gentleman sitting next to me, Brendan Murray. So here we are. Talks are broken down, and they've broken down what appears to be quite fundamentally.
Yeah, this was quite a surprise. We were all gearing up for a deal to be signed before we headed into the weekend, but here we are on the precipice of a trade war, which on paper seems like a David versus Goliath clash, economically at least. But it looks like the calculus from Ottawa's perspective to some extent is that the political costs here for Donald Trump to engage with Canada in a trade war to slap tariffs on each other might be detrimental to the Republican Party heading into the midterm elections here. So what we have are the Canadians really digging in their heels, saying, yes, we set this September 8th date as the date when our tariffs will kick in, but many of them telling us that that's really not what this is supposed to be. We expect this back and forth to go on, perhaps past the midterms and even longer. So they're preparing to support the businesses that are going to be hurt by these tariffs that went into effect at midnight on Friday.
Yeah, the Canadians saying they're going to be matching these US tariffs dollar for dollar. There is, of course, leverage, arguably, that the Canadians had, real leverage when it comes to energy. What are the expectations that they could? It's not a lever they've reached for before, but there are suggestions maybe that is part of the calculus here.
Yeah, they have hinted over the weekend that, remember, we're a big supplier of natural gas to the U.S., but initially we're going to see basically them match the tariffs that President Trump put on Friday night. It's about $20 billion, which it sounds like a lot, but it's really only about 5% of the total trade back and forth. And so what we're likely to see is the beginning with a fairly small amount of economic impact. But, of course, if we see this thing snowball, President Trump was pretty quiet over the weekend about this. He had a couple of comments about Canada, but nothing really, no major outburst. And so what we could see, though, is this escalate very quickly unless the U.S. and the trade negotiators on the U.S. side say, you know what, they called our bluff. Let's go back to the negotiating table and figure this out before they hit our products with tariffs.
And some of our reporting has been making the point that Canada has been pushing back against the US almost quite consistently, really, and taking a tough line on tariffs in a way that maybe Europe has not, and lots of other geographies have not, but maybe in a way that China has. And it's interesting that China and Canada both sort of vie for position as the biggest sources of imports into the United States. And we see that number fluctuate, but both of them feel maybe they have cards to play then.
Yeah, absolutely. And don't forget that we're going to see President Xi coming to the U.S. in a couple of weeks. And so we're going to have these two disputes. The U.S. wants to maintain its stability with China, and here it is escalating in this sort of tit-for-tat way with Canada, so which the Canadians have noted to say, look, you're treating China, which is more of an economic adversary than certainly we are, better than the Canadians are. So it's going to make for an interesting couple of weeks if the Canada-U.S. trade situation can't be diffused. Then you could have a real interesting play back and forth between Beijing and Ottawa.
In terms of, you talked about the midterms earlier on. Will the Canadians, is there a hint maybe that the Canadians will try and target goods that are relevant in those states that are going to be key when it comes to the midterms? Like, how political could this get inside the United States?
Well, their target list the last time this flared up last year, Liberation Day, when the president came out with tariffs threats against a lot of different countries, their target list was absolutely political and geographic. Some research that's come out over the weekend suggests that John Deere exports a lot of farm equipment to Canada. They make those in Iowa. There's another a big exporting community in Indiana that export campers and RVs and recreational vehicles to Canada. So we could see particular lawmakers, constituents targeted very much in a way to affect the congressional pressure that could come to bear on the administration to back down. Americans are waking up today saying, why are we really going to war in a trade war with Canada? Canadians are waking up going, we need to stay united and stand up to the bully that they call America.
OK, Bloomberg's Brendan Murray, thank you very much indeed for that update. A lot more to come through, you would suspect, on that side in the days and weeks ahead, as Brendan was saying. Brendan, thank you. Meanwhile, in the Italian banking space, this was a major story last week, of course, Banca Generali saying it is evaluating an unsolicited bid from Monte Paschi, which is also seeking to buy out Banco BPM. The bids are part of Monte Paschi's CEO Luigi Lovaglio's attempt to create a massive new Italian bank with a market cap of about 70 billion euros. Let's bring in Tommaso Ebhardt, Bloomberg's Southern Europe managing editor in Milan. Tommaso, what else has Banca Generali been saying then?
Buongiorno, Guy. Yes, Banca Generali responded Friday night to the twin bid by Monte dei Paschi CEO Luigi Lovaglio that in his effort to defend from a takeover approach by Intesa Sanpaolo made this very bold move to make two bids at one time, but one is for Banca Generali, the wealth manager of Assicurazioni Generali, and the other is for its rival, is for Monte Paschi rival Banco BPM. Banca Generali say it's considering the bid, but more importantly, we reported Friday that Generali, which owns 50% of Banca Generali, said people closer to Generali told us that they aren't opposing in principle the deal and that they will evaluate it. Is this enough for Luigi Lovaglio? Maybe not for now, but for sure we can see this as an opening act of this fight that will go along for months. The next crucial moment is October the 29th. Luigi Lovaglio called an extraordinary general meeting to get approved its plan, and he needs a 2/3 of investors to approve it to go ahead. It's not going to be easy to get it.
Yes, and just briefly then, I mean, Monte Paschi, this strategy, these bids, I mean, how is this being seen in Italy then, Tommaso? Is this being described as audacious? What words would you use?
So I would say that this is, how they say here in Italy, is again il Palio di Siena, the famous yeah, you know, it's again at the center of the stage. We have Monte dei Paschi di Siena. On one side, Italy's biggest bank is bidding for it. On the other, Siena is trying to respond with this double twin bid. Let's see how it goes.
OK, Tommaso, thanks very much. High stakes indeed. Bloomberg's Tommaso Ebhardt in Milan with a consolidation story that runs and runs. Coming up on the programme, we'll get back to the defence narrative around Europe. Another theme that runs and runs. Swedish military tech firm MilDef is Europe's best performing defence stock year to date. We'll be speaking to the company's CEO next. That conversation here on Bloomberg.
Welcome back. Happy Monday. This is the opening trade. We are 30 minutes into today's session. Across the European benchmark, losses are 0.2% so far. In Germany, the DAX is down 92 points, falling 0.3%. The FTSE 100 had been just eking out very modest gains. Now it's down 0.1%. There had been a little bit of support coming through from gold prices and basic resources, iron ore, but that has faded right now with losses there of 0.1%. Over in France, the CAC current dropping 24, close to 25 points, down 0.3%. Guy.
You know, I started the show saying summer was over. I may need to revisit as an idea. If I look at the volume numbers this morning, they are quite light. Maybe we're just waiting for things to get going, waiting for the Bessent press conference a little bit later on. Nvidia, Jackson Hole, all of that coming up this week. Anyway, we're reasonably balanced in terms of the market. 303 up, 275 down. Reasonably balanced market, but volume is light. Let's talk about the leaders and laggards. SSAB, European Steel Company. What's going on in Canada may actually benefit some of the European names. In terms of the shipping story, Maersk is travelling a little bit higher this morning, which is interesting as well, in terms of what we're seeing in and around the world, the choke points, that story front and centre. And Sagax up by 2.56%. I think we've got some movement there. In terms, I think that's an earnings story, but I could be wrong about that. Let me come back to that. In terms of the tech story, Process is down. You've got Merlin Properties also tracking a little bit lower as well. This is a sort of Spanish, Portuguese commercial real estate business. I think I think Barclays has been out with a cut this morning. And Roche Pharma down 1.4% circa at the moment. You are seeing some weakness actually pretty much across the board when it comes to the pharma space this morning, Anna.
Let's get an update, Guy, on some of the other stories we are following this morning. Treasury Secretary Scott Bessent has warned of a, quote, economic D-Day for Iran ahead of a US announcement on new measures against Tehran that is expected later today. Traders will also be watching the briefing closely for any comments on Bessent's fiscal consolidation plans after last week's announcement of increased buybacks of long-term bonds, though that announcement whipsawed the Treasury market. The Canadian government will apply counter tariffs on $20 billion worth of US products on September the 8th, escalating the feud, rocking one of the world's biggest trading relationships. Canada's envoy said the trade talks collapsed over a range of issues in the fine print. We're told the country sees little chance of resuming talks with President Trump before the midterm elections. And in technology news, Alibaba raised over $10 billion in Hong Kong's biggest secondary share sale on record, underscoring its willingness to amass and spend vast sums to take the lead in the global AI race. The capital raising reflects Alibaba's eagerness to outspend its Chinese rivals and move closer to the scale of outlays by US peers. Shares slid as much as 10% on the move, their deepest drop since April 2025. Guy.
OK, let's turn back to what we're seeing in the defence space and what's happening in Ukraine and how it's influencing the defence space. The conflict in Ukraine has, of course, changed the modern face of war. But a new report from Bloomberg Intelligence says there are still a number of structural issues holding back Europe's defences. Joining us now to discuss this, Bloomberg Intelligence senior defence analyst Wayne Sanders, who is a retired colonel who led the expeditionary cyber missions for the US Army. Good morning. Ukraine has, of course, shown the way when it comes to the cutting edge of modern warfare and how technology is changing it. Where are we now? We obviously saw this huge kind of ramp up initially and a huge kind of delta in terms of the rate of change when we saw technology being applied for the conflict. Is that rate of change beginning to slow down? Where are we now?
No, thank you so much for having me. I think we have slowed down a little bit, but I think the key is what you've actually gotten Ukraine to show the rest of the world. They have changed warfare from a contest who owns the best technology into a contest as to who can adapt that technology the fastest. So Europe understands the lesson, but its acquisition systems, fragmented industrial base, and some of the national stovepipes still make it difficult to replicate Ukraine's speed. And the U.S.'s size and bureaucracy cause a lot of the same problems that they're trying to fix. So when you look at Ukraine, one of the biggest changes isn't the drone itself. It is actually the speed of adaptation that they're going for. Cycles used to go from years into days because the soldiers are IDing the problem, engineering the modifications, and then testing and manufacturing and putting it out. So they're causing the rest of the world to start looking at doing the same things. When Ukraine can do 6 to 7 million drones per year with over 500,000 per month, and the U.S. is sitting between 50 to 100,000 per year, there's definitely a dichotomy there.
So as the speed of adaptation then has to step up, what role do key technologies play in this? What opportunities and threats do they provide? I'm thinking here about cyber and AI.
No, absolutely. They obviously start bringing that iteration chain a lot faster forward. Also, what you're seeing is that drones, AI, electronic warfare, and cyber are no longer separate. They're all part of the same kill chain now. So instead of 4 separate battlefields that commanders would look at and try and figure out separately, they're now in the same battlefield. So GPS denied environments is a great one. AI helps the machines continue to operate in that environment when communications and GPS becomes unreliable. So the drone needs software, communications, navigation, and data to work, and all of those have to start working together. And so you're seeing a lot of synergizing is the word I normally use for it, of these different industrial capacities to put all this together into one platform.
And Wayne, on Europe, you kind of touched on the fact there's a lack of synergies. There's that fragmentation in Europe. What else is holding Europe back? How constrained is Europe by the fact it doesn't have frontier AI? It may not be leading when it comes to cyber, that some of the big software names are not European names like Palantir. To what extent is that a constraint for Europe? What are the gaps that needs to close?
Yeah, I see it. I think it partly is when you look at it from country by country, the problem is that unified structure is one of the key pieces, as well as an EU legal framework that allows it, right? The United States, if you're just looking at cyber, for instance, we have National Security Presidential Memorandum 13, which enables offensive cyber with a delegated forward doctrine for defensive cyber. So trying to say, hey, all right, the rest of Europe needs to come online, and being able to use that same legal framework to move forward with it. When you look at threat sharing infrastructure, that becomes another key piece to creating a common operational platform, right? They have to be able to see the same information, see the same adversaries, whether it's in cyberspace or whether or not it's an imagery intelligence for a ballistic missile attack or a drone strike. Workforce pipeline, national EU cyber force is something that, I think that Europe could do quite well with, similar to a US cyber command, so that you have these capabilities all synergized together. I keep using that word, but it's really important in the military aspect to understand that you are using all the best things up front. And then the fourth one is technology integration. Programs like Maven and Scale AI, and like you mentioned, Palantir on the US side, and also the frameworks of like AUKUS Pillar 2, where they're looking at these emerging technologies. So companies like Thales, BAE, Leonardo, and Rheinmetall, I think, are the key ones that are partnering right now with the US companies as well. Palantir, Scale AI, Booz Allen Hamilton, and Leidos, to try and put these together into some type of global framework for allies.
Okay, really interesting. The importance there for Europe, of course, in the space around cyber and AI and modernised warfare. Wayne Sanders, Bloomberg Intelligence Senior Defence Analyst, with that analysis. Wayne, thank you. Let's stay on the defence space now, because a small Swedish firm whose products include rugged laptops and computer screens for armoured vehicles is Europe's best performing defence stock this year so far. It's an ascent that its chief executive puts down to a third wave of military spending that's focused more on computer systems and drones than tanks and ammunition. For more, let's bring in Daniel Ljunggren, CEO of Swedish defence tech firm MilDef. Daniel, good morning. You talk about this third wave then. Where are we in this third wave, and to what extent is it propelling that demand, and how sustained is that demand for your products and services?
Good morning, and thank you for having me. That's a really good question, where we are in the different waves, to say. The third wave is around building this long-term threshold effect that they were seeking, building up this European data-driven defense capabilities. And that has taken some time. The first wave was more around ammunition and boots and fuels and things like that. And then the second wave was around filling up the order backlog at the big primes with the platforms, the vehicles, the tanks and the aircraft and things like that. But in the third wave that we have referred to is when they need to equip this kind of platform with tactical IT, as we say. They need their IT backbone out in the field. And that is really a sweet spot now for MilDef when we move into the third wave. And I think we have been seeing the third wave coming here the last 12 months, something like that. But it's the need and the demand for this kind of build-up of digitalization of the armed forces. We see a clear demand going forward, and that will probably keep up for a couple of years out in time as well.
OK, so a couple of years more of this, possibly. What are the biggest constraints to delivering on that demand?
There is, of course, challenges. It's challenging to grow that fast as we are doing. You can feel the growing pain. You need the organization to be ready. So we have really stress tested the organization the last year with ramping up the delivery capacity that we have. We have sometimes challenging on the component side. For example, you can see the global memory situation that we have had now for a while. It could be a challenging situation, but I think that we have solved this delivery capacity in a good way, and we have now ramped up where we are on a total different level, where we can increase speed and reduce lead times when it comes to this kind of rugged equipment that we are delivering.
Daniel, have the lessons from Ukraine been learned, or are they still being learned?
I think we're still on a learning curve all the time, absolutely. We've seen that drones are here and probably will be here to stay, and the anti-drone solutions will also be here to stay. But I think future modern warfare will be a combination of the drones, anti-drones, but also the more traditional warfare that we have seen in the past. But one thing is absolutely clear from our point of view, and that creates the sweet spot for MilDef a little bit. It's around the digitalization of the armed forces. we need to build up these data-driven defense capabilities, and that will require a lot of tactical IT as a backbone at the armed forces, and that is exactly what we are delivering. Our full portfolio is around the communication, positioning systems, sensor systems, radar system, and I think also AI on top of that in the future will drive a high need for data capacity.
Yep. And is the cadence, the product life cycle, increasing in terms of how often you need to update, how quickly we can go through changes? Military equipment in the past has existed for a long time, then you get an upgrade. Is this a sector now where it's just constantly being upgraded?
I think we are in that phase where everything else needs to be constantly upgraded. You have to be able to have the capability out on the field. It's around the capacity. And then you need to upgrade all the time. So you need to adjust, and you need to be quick, and you need to have a shorter loop when it comes to new developments, adjusting things like that. So absolutely, there is a shift when it comes to the time question here. Things needs to be more rapid than it has been in the past.
And Daniel, where do you see European governments willing to spend, able to spend, and able to make decisions quickly? We've talked a couple of times already in this conversation about the faster speed of adaptation required. And where do you see governments that are really grasping this?
If we go back to February 2022 and the full-scale invasion of Ukraine, we thought that everyone in this industry thought that it's going to go quite quickly here. But we also have learned during these 5 years that there is a clear slowness in the system, so you need to be ready for that. But I think we have now really seen a governance side, a procurement agencies that is really starting to picking up the pace, I would say. They have done their journey and they are ready to improve the European defense capacity. And that is, of course, something that we have seen now in the last 12, 18 months, something that the pace is increasing, time is of essence here. So everyone is trying to do whatever they can to increase the pace. But in the beginning, it was a total defense ecosystem in Europe that was we saw bottlenecks all over the place, but now I think all of this kind of bottleneck has been addressed, and we are in a better position than we were a couple of years ago. So I think it's a great time to accelerate the speed here and now.
Daniel, we wish you well. Thank you very much indeed for your time this morning. Daniel Ljunggren, the CEO of MilDef. Coming up, a so-called economic D-Day for Iran, what the US Treasury Secretary's plan could entail and how it could impact China. We will discuss all of that next. This is Bloomberg.
Welcome back to the Opening Trade. We are 47 minutes into the Monday session. European stocks just off by 0.2%, Anna.
Let's talk about one of the events that we're certainly watching out for today, and this is a briefing by the US Treasury Secretary Scott Bessent, who has vowed an economic D-Day is coming for Iran, with details of an isolation plan set to be unveiled at a press conference later today. But significant new economic pressure is likely to prompt Tehran and perhaps China to retaliate. Let's get into the details and the complexities of these relationships behind this story. Bloomberg's Abu Omar joins us in Dubai, and Balash Pens is in Hong Kong. Abir, let me come to you first. So what do we anticipate then the economic isolation plan will entail? What are we going to hear from Scott Bessent later on?
Yeah, good morning, Anna. So it's widely expected that the plan is actually going to include secondary sanctions against countries that decide to continue to do trade and financial transactions with Iran. Now, you've mentioned in your intro China being one of those countries. And of course, China is a big purchaser of Iranian oil. 90% of Iranian oil goes to China. So questions about those secondary sanctions would bring to the table wider conversations about trade, tariff war between the United States and Iran, and Iran, of course. And this comes at a precarious time where Xi Jinping is going to the United States next month. So that is one big question. And then the other big question is the reaction that we're going to see out of the Gulf and what Iran decides to do, because the economic isolation that the U.S. has in place or decides to have in place, while we don't have a lot of clarity about it, it may put Iran in a difficult position. But first of all, it'll take months for that pressure to start being felt in Iran, despite the fact that we know that their oil exports are around near zero for the time being. But it will probably put Iran in a difficult position in a few months' time. And then what will Iran do is the big question. It will have no alternative but to retaliate. And then the question that comes after that, of course, is how will Iran retaliate? Will it come in the shape of attacking Gulf countries? That, of course, puts us in a situation similar to the end of February, beginning of March, where we have a widening parameters of this war. And that is a situation that no one wants to be back at again. So those are all the indicators that we will be watching out in that supposed press conference that Scott Bessent will have later today. And what exactly that economic isolation will entail is going to be the big question that will be, of course, looking out for.
Abir, thank you very much indeed for the update, the Gulf perspective. Let's talk about the China perspective. Let's bring in Balash and get a sense of what we are watching here from the China perspective. How big a step would it be, Balash, to bring China in? Now, the connection is very strong between China and Iran, but it feels like this would be a big step. If that happens, how could Beijing respond?
Without a doubt, the China question looms large as we await this announcement from Scott Bessent. And it's not just the oil buying, it's also the Chinese banks involved in the financing of that trade. And look, over the past day or so, China has come out a couple of times to talk about how they don't believe in economic sanctions as a way to resolve this conflict. And this is something they've said over and over and over again in connection with many different conflicts around the world. And China has shown that they're not afraid to go toe-to-toe with the U.S. when it comes to economic sanctions, when it comes to trade, when it comes to tariffs. We remember that sort of escalating tariff war between the two sides. And we also remember China sort of shutting off rare earths trade, which ended up bringing in the trade truce between the U.S. and China. How much appetite does the U.S. have to kind of restart that process and to kind of enter into this economic Cold War with China again? How far are they willing to push? Those are very, very important questions. But it's very clear from the Beijing side that they are paying very close attention to this, and they have shown in the past that they're not afraid to push back against the U.S.
Yep, it's going to be an interesting watch, isn't it? Certainly from Beijing's perspective. Balash, thank you very much indeed. Balash Penn's joining us in Hong Kong. Abir, obviously joining us in Dubai. Both sides of this covered, and I think both areas are going to be watching this very, very carefully a little bit later on, Tom. OK, here's what else to think about then throughout the week. Later today, Scott Bessent will be holding that press conference then on US plans to hit Iran's economy, as we've been discussing. We'll be across that for you, of course. On Tuesday, tomorrow, Germany's GDP print crosses and the IFO Business Climate Survey as well. On Wednesday, another major event. Guys calling it a macro event. It could possibly be that. Nvidia's second quarter earnings. You also got US core PCE, so another gauge on the inflation story, of course, in focus for the Fed as well. Talking of the Fed, Thursday, Jackson Hole, that economic symposium starts, and it's the big one in terms of speeches. Kevin Warsh, what will he say? Delivering that keynote address at Jackson Hole on Friday. Let's turn back to the markets now with Adam Linton from our Markets Live team. Adam, we could start with Bessent, we could start with Kevin Warsh. Let's start with the US Treasury Secretary. What for you do you think will be the focus for markets? Will it be Iran? Will it be anything he says about how to consolidate the fiscal story in the US, or a bit of both?
Yeah, I think a bit of both, definitely. I mean, you've seen oil prices are a little bit lower today ahead of this potential Bessent announcement. It's been framed as the US administration as a potential way to draw an end to the conflict, and the implicit acknowledgement there is they don't want to escalate military attacks. But I think from a market perspective, it's still fraught with risk. We've seen that Iran could threaten to further curtail flows to the Strait of Hormuz. It doesn't stop Iran from attacking energy infrastructure. And also we've seen, with sanctions between Russia and Ukraine, they aren't particularly that effective. So I think there's definitely a risk this further inflames the situation rather than remedies it in any particular way. And it just makes an off-ramp for the market more difficult to see. And as long as that's the case, then upside risks to oil markets still remain.
Yeah, I think we've got some pretty messy expectations around Bessent today, haven't we, Adam? Because there's this briefing planned around Iran. He set the stage with some really strong language about what he's going to be talking about, and this economic D-Day for Iran and the step-up in sanctions and everything that goes with that. At the same time, there is a sort of sidebar story about fiscal discipline in the US, which can't ever be a sidebar. I mean, you couldn't really push that to the side. So I wonder how anybody's expectations are going to be met today.
Yeah, I mean, that's ultimately the thing. Bessent definitely has his work cut out. I mean, we've seen for the administration over the past week, they're uncomfortable where longer-dated yields are, and you can assume that this is another attempt to potentially quell some of those concerns and kind of bring a bit of order to the market. But as we saw last week with the long-dated buyback announcement, the market didn't really buy it. And, if there's fiscal consolidation, that's a real tough bar for to be able to dispel market concerns. We saw with the Doge efforts under Elon Musk, didn't really achieve a great deal. And I think there's a risk that if the market sees these as particularly piecemeal, then we could potentially see further pressure on longer dated bonds.
Nasdaq futures down 8.9% right now. They've been going south throughout most of the morning. How big an event can Nvidia be?
Yeah, I think Nvidia, it's not just a stock specific or a sector specific. Yeah. It's a macro data point. I think for Nvidia themselves, I think it's interesting that over the past month they've been holding up whilst some of the other semis have been rolling over. So let's see if that can be sustained. But I think ultimately for the tech sector, it's basically a report cards on the capex cycle and how much more we can get out of this. And I think also kind of ties to what we're looking out for with Bessent this week. Longer dated borrowing costs will draw further the scrutiny on this. And then for broader macro traders and what we're looking out for, obviously we now know that AI spending is a key input into US GDP. And we saw comments, I think it's from Kashkari last week, saying that AI spending, that serves to raise our stars. So there's a lot of interconnectedness this week we need to be on top of.
OK, Adam Linton, thank you very much indeed from our Markets Live team. Yeah, let's see if it is interconnected or disparate. And, of course, what Warsh has to say to wrap up the week and whether he gives us any more steer in terms of how he sees inflation progressing. He thinks AI ultimately is going to be disinflationary. He does.
It's interesting also that Bessent is quite concerned about not only Treasury yields, but also the cost of capital for the AI trade.
Yes, absolutely. And I wonder how much the fact that this is a summer week still, we keep saying that, the news agenda suggests that summer is over, but the volumes, to your point earlier, Guy, don't suggest that, certainly in Europe. And so you wonder if the markets can keep up with some of these dynamics later. Let me tell you that Guggenheim CIO Anne Walsh will be joining the surveillance team at 1 o'clock London time. That's it for the opening trade. This is Bloomberg.